Good afternoon, everyone, and thank you for joining us. I'm Hailey Miller, Director of Government Affairs and Public Policy at the Digital Power Network. I'm thrilled to be moderating this fireside chat, bringing crypto to Main Street, the role of state banks. As digital assets continue to evolve, so does the conversation around their regulation. And state regulators are sitting at a fascinating intersection of innovation, consumer protection, and financial stability. Today we're fortunate to hear from someone with a front row seat to that evolving dynamic. Please join me in welcoming Brandon Milhorn, President and CEO of the Conference of State Bank Supervisors. Brandon brings decades of experience across federal and state level policy and is now helping lead the charge on how state supervision adapts to this digital frontier. Welcome, Brandon.
Thank you, David.
From your vantage point at CSBS, how do you see state supervisors fitting into the evolving crypto ecosystem?
I like to. Oh, now I can hear myself. That's unfortunate. I like to remind people that states aren't new to this ballgame. For the last decade, really for over 100 years, we've been regulating money transmission. And for the last decade, we've had $50 billion worth of stablecoins covered already under money transmission rules. And the states, as a group, just passed the Money Transmission Modernization Act. Multiple states for licensed money transmitters, 99% of the transactions are covered. We've got strong capital and liquidity rules for these money transmitters, and consumers trust it. That to me is the most interesting part of it. Our financial system depends on trust. And whether it's banks or money transmitters or other non-banks, that trust is key. And we need to build that for the digital asset infrastructure.
What are the most common concerns state regulators and institutions they supervise, both banks and non-banks, have when it comes to digital assets?
Yeah, I would say stability and predictability. If it's something that a consumer is concerned about, if you're worried about it, if you were worried about it in your wallet at home, you're going to be worried about it in the context of a digital asset, and state supervisors share those concerns. If we can provide for a framework that adds stability and predictability to digital assets, I think of stablecoins in particular. The opportunities are tremendous: lower transaction costs, faster transactions, the ability to reach underserved communities more quickly. And if we can manage that risk with consistency and stability and predictability, then we can produce a framework that's really effective for both industry to innovate and consumers.
How do you see the role of state regulation evolving in a world where digital assets are becoming increasingly borderless?
Yeah, we work across borders all the time with the states, including international money transmitters. But I think of it this way: if you've got a money transmitter that's working in more than one state, state supervisors are working together on supervision and policy relative to that entity. No different for what we're doing and need to do for digital assets and stablecoins. We're working very hard, very closely with Congress to provide that national framework for stablecoins. We're very supportive of the efforts that we see in Congress to move us in that direction. Borderless is important. We've got to knock down barriers to innovation. We've got to provide consumers with better access to services. Digital assets are part of that structure for us.
With your experience firsthand at the state level, what would you like to remind Congress and regulators at the federal level?
Yeah, the importance of trust is so key. And so as we look at both the Senate and House versions of the stablecoin bills, one of the things I first look at is, do we have confidence in the liquidity and capital structure relative to the stablecoin issuer? And are we just allowing them to issue stablecoins and use them for payments, or are you authorizing other activities? Because the more activities you authorize, the more risk you build into the business model, the stronger your liquidity stack has to be, the stronger your capital buffer has to be, not just from a regulator standpoint, but from a trust standpoint. We've seen the consequences when consumers lose trust in the instruments they're holding. That's why we have runs on banks. We saw it with Circle in 2023 when they had a portion of their reserves held up in Silicon Valley Bank. The only opportunity there is you've got to have stronger reserve requirements, or you've got to have a capital buffer that gives consumers confidence. And so we think we can build that with the national framework. So liquidity, capital, gives confidence. Then consumers have to trust that the instrument they're holding has value and will retain that value, including in the context of bankruptcy. So we want to make sure that consumers are protected in the context of a bankruptcy proceeding. And just keep in mind, priority in bankruptcy is different from bankruptcy remote. Right? In bankruptcy remote, consumers get access to their funds right away. If you just have a priority, you're in there with the rest of the creditors, and it might take a period of time before your claims can be met. So that liquidity and capital, consumer confidence driven by trust in the system, and then what we would like to see is parity between federal licensees and state licensees. We have the most dynamic banking system in the United States because of differences between state and federal regulators. And we want that to carry over to the innovation that's permissible in the context of stablecoins, right? If there's a strong national framework and states have committed to meeting that floor in the national framework, then their license should be treated the same as a federal license. If a federal licensee can work across the United States, an issuer that meets those federal requirements in a state should have the same benefits.
If we're sitting here a year from now, what progress would you like to see made on this front?
Yeah, I would love to see that national framework for stablecoins passed. It's so critical. And make sure that it's got the capital and liquidity requirements that we need to support a strong and trusted system. Build consumer confidence, because that framework includes protections for consumers, not just BSA/AML, but also in bankruptcy. And then, because we have that trust in the system, build, right? To me, that's the beauty of that framework. I tell my team all the time, you forget that a framework, a process, a roadmap actually provides you with flexibility. If you can have that baseline of rules and policy and guardrails, that provides you flexibility to innovate within those guardrails. I think that's what we've been missing. If we can add that at the state and federal level, that's going to be a key component to unlock innovation in the United States.
What do you think is the most important takeaway for the folks listening here today?
Well, I mean, one, just remember that the states are out there protecting you right now. You know, I think sometimes within the Beltway, you forget, if they feel like if there's not a federal regulator, there's not protection for consumers, or there's not a framework for operating. And that's just false. There's nothing magic about a federal law. There's nothing omniscient about a federal regulator. They make mistakes too. So what we want is as many regulators working with industry, talking to industry, engaging with industry, building that sound policy. To me, that's the beauty of the dual banking system. I want to create that for digital assets as well.
Well, Brandon, thank you so much for your insights today, and thank you for being part of this conversation. Enjoy the rest of the program.
Hailey, thank you for having us. Thank you, guys.